What are the tax implications of peer-to-peer lending? Have you ever wondered how peer-to-peer lending affects your taxes? This modern way of borrowing and lending money can have some interesting tax implications. Let's break it down to understand what you need to know. First, when you borrow money through peer-to-peer lending, that loan is generally not considered taxable income. This is because you are expected to pay it back. However, if the loan is forgiven or canceled, the amount forgiven could be treated as taxable income. This means you might owe taxes on that amount, depending on your local tax laws. Now let's talk about the lenders. If you lend money through a peer-to-peer platform, you earn interest on that loan. This interest is usually considered taxable income as well. In many places, it is taxed as savings income, so you will need to report it on your tax return. When it comes to bankruptcy or debt relief, things can get a bit more complicated. If a borrower defaults on a loan and it gets forgiven, the lender may not receive any repayment. However, the borrower might face tax liabilities on that forgiven amount. This is something to keep in mind if you are considering peer-to-peer lending as a borrower. For lenders, if you experience losses from loans that cannot be recovered, there may be ways to offset those losses against other income from peer-to-peer lending. In some regions, tax relief mechanisms allow lenders to claim deductions for bad debts. This could help reduce your overall tax burden. Additionally, if the loan is considered a capital asset, lenders might be able to claim capital losses if the loan becomes irrecoverable. This can depend on specific tax laws and the nature of the loan, so it is wise to consult a tax professional. In the context of bankruptcy or debt relief, peer-to-peer lending can provide alternative financing options for individuals or businesses facing financial challenges. However, both borrowers and lenders should be aware of the potential tax implications involved. Borrowers can gain access to funds when traditional options are not available, but they should be cautious about any tax liabilities that may arise if their loans are forgiven. Lenders need to understand the tax laws regarding interest income and loss relief to navigate their responsibilities effectively. Overall, while peer-to-peer lending can open doors to financial opportunities, it is essential to be informed about the tax implications, especially in situations involving bankruptcy or debt relief. Consulting with a tax professional can ensure you are compliant with all relevant tax laws and regulations.